Yo, 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 and welcome back to Sticks and Stones, the podcast where we bring serious cigar smokers together with serious deal makers. And welcome to episode 15, Commercial Loans. And what are we smoking on this episode? We are smoking The Banker by H. Upman. And this is the day trader. You know, they came out with The Banker a while ago, and I think they have multiple versions of it. This is the day trader. So that is what we are getting into, boys and girls. So let's get this party started. We're gonna cut this up here real quick. Gonna do my straight cut on this bad boy. And why am I doing this episode? Why are we shooting this episode about this subject? Well, I'm glad you asked. I get so many questions from people on loans, type of loans. I'm not even talking about interest rates because the interest rates are always going to fluctuate. It all depends on, the time, the Fed, whatever. You know what? I'm going to refill my lighter while I'm on here. In case if you don't know, you want to purge your torch or else you're going to get bad performance out of it. You want to make sure it's completely purged because then you're going to get like sputter and all kinds of stuff. So I'm purging my torch right now of any residual butane. And then I like to try to dry light it, dry fire a couple times just to make sure there is no butane left in. Purge that a few more times. And basically, if you're not watching, you have something that's small enough to get where the needle is, where you inject the butane, and then you press it down with that small object, whatever it is. I have a pipe cleaning tool, like a multi-tool. I'm now going to shake up my butane, and then I am going to spurt some in there. And this particular torch, I love this torch. It's from Corona Cigar Company in Orlando, Florida, but I always get problems with it. I don't know if it was just an odd size. So you want to warm it up with your body temperature because you don't want to go just cold. There we go. All right, now that we've done that, we've done a little tutorial on how to purge and refill your torch. Why are we filming this episode? I'm glad you asked. Commercial loans. So no matter what field you're in, I am in commercial real estate. If anyone doesn't know, if you're just tuning in for the first time, I'm in commercial real estate. I am a broker in 2 states working on actually going to be taking the test for my 3rd state very soon. So whether it's real estate, whether it's sales of any kind, whether that be commercial vehicles, whether that be trailers, whatever you sell, if you're selling heavy equipment, anything of a high ticket price tag, you may encounter lending. You may encounter clients, customers, buyers that need lending of some sort. Need a bank. They need bank intervention. They need a loan. And a lot of people in the United States of America have purchased a home. I mean, it's a pretty common thing, right? So that's something that you're very familiar with. A lot of people are. A lot of people are familiar with buying a home, right? So you go to your bank, the bank that you bank with all the time, your daily, your Monday through Friday banking institution, whether that be JP Morgan Chase, Bank of America, TD Bank North, whoever that is, your local credit union, whatever, Capital One, whatnot. And you go and you fill out a bunch of documents, an application, ask a bunch of questions or get asked a bunch of questions. So you answer those questions on these applications, and there's a bunch of bullshit you got to go through. Supply your tax returns, and you get a pre-approval letter. You're able to buy a house up to X amount of dollars and at a certain loan to value, meaning you're going to have to put X amount of percentage of that sale price down towards the down payment, and then you're able to get, X amount of thousands of dollars. You qualify for a $600,000 home with 10% down, 90% LTV. Okay, great. Very simple. Most of those loans are, straight loans, straight mortgages, 30-year fixed, 25-year fixed, 20-year fixed. Very simple stuff in the grand scheme of things. Then I deal with a lot of first-time commercial buyers, and I see commercial buyers in a lot of different categories, a lot of different tiers, a lot of different walks of life. So I get the owner operators. They started their business out of their garage. They've made a good amount of money, and now they want to go and buy a small assembly facility, 5,000 square foot warehouse essentially. and they want to, continue building the dream. By the way, I'm sucking back on my new favorite winter cocktail, the apple old fashioned. If you're interested, I have the recipe on our Instagram stories, I believe, where I show you the entire thing. It's really awesome and less sugar than doing, your standard old fashioned. And the bourbon I used on this is the Elijah Craig Toasted Barrel. Awesome stuff. Anyway, somebody who's started a business, they want to expand it, they want to buy a warehouse to do their assembly, whatever. That is called owner operator financing. That is an owner operator. And then you have people that, they have a couple of residential income producing properties, or also known as rent houses, and they want to step up. Let's just say they have 2 or 3 rent houses, and they want to step up to a 6-unit apartment building, 6 apartments in one building. Okay. That's a quintessential commercial real estate investor. And there's all different walks of life. There's institutional investors where, these are people that probably a conglomerate, a couple of big companies get together and start this entity, and they're buying and selling, or buying and developing, thousands and thousands of units, thousands of apartment buildings across the country, or the world for that matter. That's an institutional investor. I see all of them. And while I'm smoking The Banker by H. Upman, I deal with a lot of buyers that are kind of first time, and they don't really know a lot about commercial loans or commercial lending, right? So that's why I decided to shoot this podcast episode, because commercial lenders, they're very different. They are not the average bear. So they do things a lot differently. And there are tons of different vehicles that a lender could use to finance you a building. You do have straight conventional mortgages. You have lines of credit. You have SBA loans, which is the Small Business Administration. They offer financing to small businesses. You have to qualify. There's a bunch of fired hoops you have to jump through. But why people jump through those hoops is because the SBA will float you a loan at very low interest rates, because they're incentivizing Americans to build businesses. And then you have very creative lenders. You have creative financing. And that's like private equity. That's people with lots of money, business people that want to make more interest money than they would if they sock their money into a bank account. You go to a bank, any one of your banks, and let's just say you've got $100 million sitting in your bank account, and you want to make more than the 0.025 or 0.043, whatever the interest rate is that your bank is offering. Let's just say you want to make more than that. You want to make 7, 8, 9, 10, 11, 12% interest on your money. That's where private equity lenders come in. They will lend you money, and they will get, traditionally they don't do 30-year mortgages. They'll do like a 12-year mortgage, 15-year mortgage, something like that. And they'll give you an interest rate that's traditionally a little bit higher than prime, the standard banking interest rate, but they're not going to, their underwriting standards are going to be, I would say, kind of middle of the road. They're gonna want some recourse if you don't pay your mortgage. Then you've got things like hard money loans, where let's just say you want to buy $1 million building. A hard money lender will lend you that $1 million, but they're going to do it on a very short-term basis. And I'm talking 6 months, 12 months. The most I've ever seen was like a 24-month hard money loan. And the interest rate is going to be skyrocketed. It's 12, 15, 20%. Traditional banks, JP Morgan Chase, does not offer hard money loans. Most lenders don't do hard money loans because they're very risky. And somebody would do a hard money loan because they don't have the time. Let's just say, I'm just going to give you this scenario. Okay, I'm going to give you the imaginary story here. You find a building that you want and you need. It's of a huge value to your business. you're an owner operator, and you want to buy this building and it's $1 million, and you don't have $1 million cash to buy this building. So you go to a hard money lender, and a hard money lender says, okay, I want 30% down. So you got to come up with 300 grand. Okay, fine. You have the 300 grand. I want 18% interest, and I'm only going to float you this note for 12 months. You close on the property in that 12-month period. You either have to pay off the 700,000 plus interest, or you have to find a conventional loan to balloon that payment out to the hard money lender and then float you a normal mortgage, longer term, 25, 30-year mortgage. There's all sorts of lending in commercial real estate. And I would say in businesses in general, lines of credit and SBA loans and all that kind of stuff. But it gets very attractive. It gets very complicated. It also gets very complicated. So just, keep that, put that in your hat. It gets very complicated. Commercial lending usually will not, we're talking conventional bank, they're usually going to be 20 to 25% down. That's kind of a general standard. It could go up from there, but the general standard is like 20, 25% down. That's a lot of money. That's a lot of cash when you're talking about, a $3, $4, $5 million building. It doesn't really matter if it's, not that I say it doesn't matter, because it's all money, right? It's all money. But it's $500,000, $600,000, $700,000 building. A commercial lender, JP Morgan Chase is going to want 25, 30% down. When you are an owner operator, banks, commercial lenders are going to have stipulations. They're going to tell you that we're not going to write the loan. We're not going to issue the mortgage to you as an individual. We're not even going to issue the mortgage to you, the business, Acme Rocket Company. We're not issuing you the mortgage to Acme Rocket Company. You have to create an entity called 123 Main Street LLC. And then you, 123 Main Street LLC, because the building's on 123 Main Street, you are going to write a lease to yourself, Acme Rocket Company. I'm going by the old Roadrunner cartoons. The bank wants to know that even if Acme Rocket Company goes completely out of business, goes tits up, they didn't write a mortgage to a company that went bankrupt. They wrote a mortgage to a real estate holding company. So you're leasing to yourself. I mean, these are some of the things that happen in commercial real estate. This is the things that happen in commercial lending. Let's just say you tell me, and you know what? Blow it out your ass. I didn't pay attention to a fucking word you said just now. Here's what I tell you. I tell you that commercial lending, bare bones, when you think commercial lending, understand it's a lot more underwriting. You have to jump through a lot more fired hoops. It's a lot more money down, 20% minimum. And some banks won't even take 20%. It's like 25% minimum. So it's more complicated underwriting, and it's more money down. Because after all, you're not buying a home that you're living in, because you're living in it. If they take it from you, where the fuck are you going to go? It's your house. So it's a lot less down payment. Some people can clear for a 90% LTV, so 10% down, or zero, like 100% mortgage, 0% down, just, sign and drive or sign and live. Commercial lending is completely different. And then you get into the really creative shit where you've got debt service loans. What's a debt service loan, Ange? I'm glad you asked. A debt service loan is if you are a very astute, a very resourceful guy or gal, and you find a property that, let's just say it's 4 units. Let's just say it's 4 apartments, and the net operating income, meaning the gross income less all of the expenses, the mortgage, all of the maintenance, like whatever, the alarm system, taxes, like everything, you have net income and it's really high. You can get a loan on that building because of the really high net operating income. And at that point, the lender, debt service lender, there are lenders that specifically do debt service, and that's like their main bread and butter. They will write you a loan. They'll cut you a check on the asset, not your personal credit, not your business credit. They don't even give a shit who you are. If you find the deal, if you find the property that's got a high NOI, or a very high upside, a very high value add, which I have a podcast about value add, but if or a podcast episode about value add. So if you have a value add property, they'll write you the mortgage based on the NOI. They'll write you the mortgage based on the property itself. They don't give a shit about you because you found a great property. But I will tell you this, a lot of people are looking for debt service loans. These people are not stupid. They didn't get where they're at because they're stupid. They're not there lending people millions of dollars because they got taken advantage of. I can tell you that right now. If you don't have a really stellar debt service property, you ain't getting no loan. I can tell you that right now. On a really great debt service loan, you're not putting shit down. You're putting zero down, signed, and mortgage. That's what's happening. But those properties are few and far between because any property is going to have challenges. Any property is going to have challenges. You know, you're going to have a unit that is vacant. You're going to have a unit with a tenant that is back 6 months rent, hasn't paid in 6 months. You're going to have challenges. And when you have those challenges, the debt service lenders are not going to be as apt to lend it to you. So here's what I can tell you. I can tell you that if you're going to purchase a commercial building, a commercial property, whether that's an office, whether that's retail, whether it's a warehouse, whatever it is, a multifamily building, commercial lending is much more complicated. They're going to ask you more questions. They're going to want to see more proof, more documentation. They're going to ask you for a larger down payment. I mean, this is H.R. Upman, guys. I mean, it doesn't get much better than that. It's a very good stick. It's a little light for my palate. It's a little light for my strength because I'm usually medium to bold body, but it's still good. As I was saying, you're going to be going through a lot of underwriting, which is someone going through all of your proof of income, your documentation on how you made your money, when you made your money, how much money you make, how consistent it is, what your debt to income ratios are, how profitable your business is, your net worth. Like all of these things are going to go into commercial lending. I would say in a real estate application, in a real estate world, it's best to do it all cash. All cash. You can do whatever you want. It used to be back in the day when you said all cash, you got some pretty stellar deals. You held the gold, so you made the rules. It's not like that anymore. So many people have cash and are buying with cash. It's kind of like when you say, I'm all cash. People are like, oh, yeah, okay. And the other three people that are interested in my building are all cash. Or there's so many people that are qualifying for so many loans today that it's essentially better than cash because a bank can give more money than somebody that's paying all cash. Somebody who's paying all cash wants a better deal because it's all cash and it's an easier, more simplistic deal. But today people are clearing for so many loans, commercial loans, that it's like, yeah, he's all cash, but this is like 30-40% more money. Someone's going to go with that. So, all cash is a lot more simplistic. It's a lot easier deal, but it doesn't hold the weight that it used to. Having said that, when you do have a commercial loan, a lender is going to ask for a lot more information. Like when you buy a building all cash, any property all cash, you don't even have to have a fucking survey. It's not required because you are paying all the money. If you're buying a property that has an encroachment on it, you're encroaching on someone else's property, that's your fucking problem. And if they come at you for that, if they regulate against you for that, then you just lost more property because you didn't do a damn survey. But when you're buying all cash, you don't have to do a survey. You don't have to do an environmental assessment. You don't have to do shit basically when you're buying all cash. Now, when you're buying through a commercial lender, that commercial lender is going to have some criteria, some stipulations. Okay, you're going to have to pay $2,500 for an appraisal. You're going to have to pay $1,500, $2,000 for an environmental assessment. You're going to have to pay $1,500, $2,000, $2,500 for a survey, depending on how big the property is. These are all things that a bank, a lender, is going to ask for. If they ask for it, That means if something pops up on any one of those reports that they don't like, they're not lending to you. So those are the big differences. And then when you get into SBA loans, the SBA they pawn it off like, yeah, it's the way that we're going to stimulate the economy, and we're going to create all kinds of shit for small businesses, and we want small businesses to thrive and to grow and expand. And it's all bullshit. They put you through, I want to say 9 out of 10 people that I know that have gotten an SBA loan. And an SBA loan doesn't have just to be on property. It could be an SBA loan for building up your business, for expanding your business, for starting your business, whatever it could be. 9 out of 10 people that have gotten an SBA loan will never do another one ever again. Never. And just to clarify, the SBA loans are not actually issued by the federal government. They're backed by the federal government, but they are issued by individual banks. Bank of America, Capital One, JP Morgan Chase. They will do SBA loans. Depending on if your bank qualifies, could be a small community bank, could be a small local bank, could be a credit union. They all issue, if they meet the SBA's requirement, they will all issue SBA loans. Anyone that I know, like I said, 9 out of 10 people that I know have gotten SBA loans will never do another one again. They put you through so much hell and so much restriction, they scrutinize everything you submit to them and ask you for more and more information. But that's not the worst part. The worst part is they give you stipulations. Like, if you can only get this money if you qualify by using X amount percentage for operating expenses, X amount of percentage for payroll, and then X. It's crazy. It's crazy what SBA loans stipulate how you can get the money, because it's not just, okay, you've been approved and we've given you the money, but now in order to actually disperse the money, you have to jump through these following hoops. It's crazy. Let's say you're an investor. Let's say you get this like once in a lifetime opportunity, and you want to buy this property, and it's like a retail center, and there's 10 stores, 9 of them are leased. You have a 90% occupancy rate. Commercial lenders in your mortgage documents are going to stipulate that every year, every 2 years, every whatever cycle it might be, they want to audit all of your leases. They want to audit your tenant list. They want to see what the permitted uses are. And if any of those conflict with their standards, they can call due your note and say, you owe us now. We need to accelerate your mortgage, and you have $8 million left on your mortgage. You owe us $8 million in 30 days. Commercial lending can get very, very complex, guys. I'm not going to lie to you. I'm not going to sugarcoat it. Commercial lending can get very, very complex. It can get very difficult. And every instance of it, whether it's hard money loan, whether it's an SBA loan, whether it's a short-term loan, a long-term loan, a straight, whatever you're looking at, it is more complicated. It's not complicated if you have a good mortgage broker, or if you have a good banker. If you have someone who knows what they're talking about, it can walk you through it and help you through it. Like I say, my personal opinion, the best option is going all cash if you got it like that. But if you don't got it like that, you got to get it. You have to get a loan. It is what it is. That is the type of debt that a lot of people opt for, is the mortgage. So if you got to do it, you got to do it, but just know what you're getting involved in. Have somebody who can bring you up to speed on all of this stuff. It is a very difficult subject. And don't get me wrong, commercial real estate and commercial lending is nowhere near as simplistic as residential lending, residential mortgages. But the upside is far greater. The upside is far greater. You are not going to potentially, I don't say this for every single application, but potentially you are not going to make the income that you would in commercial or in residential that you would in commercial. If you have 4 rent houses and you're making $1,500 a month on each of those rent houses, you're making $6,000 a month. In residential, you cannot charge triple net rent in most states. So that $1,500 does not equate your mortgage payments, your tax payments, any maintenance. All of that is rolled in. So if you've got $99 of expenses, taxes, mortgage, you just replaced an AC unit or a boiler or a hot water heater, you made $1 that month. Sometimes there are people out there that go negative. They've got more expenses and more maintenance than they've got rent. So they're upside down. They've got negative equity in a rental income producing property, which it ain't producing shit. It's not producing any income. It's actually producing debt. In commercial, with the exception of multifamily, it's just there's a lot more units potentially because you could buy 100 apartment building, an apartment building with 100 doors. That's a lot of rent. That's a lot of rental units. So whatever your mortgage is going to be and your taxes and maintenance and all that, for the most part, if you run things right, you have 100 doors, you're making a lot of money each month in profit. But in most all other circumstances in commercial real estate, you can offer a triple net rent structure, meaning I want in my pocket for your, call it a retail store, I want $3,000 a month in my pocket. Everything else that comes out of my pocket, every expense, the capex, the mortgage, and all of that stuff, the taxes, any maintenance, any of those fees, any utilities that can't be individually metered to the tenant, all gets paid back by the tenant. So my $3,000 goes directly in my pocket. All of the expenses are all paid for by the tenant. And let's just say you've got 30 stores like that in one building. You're making a ton of pure profit money. You can't do that in residential. You just can't. So commercial might be a little complex. Commercial lending might be a little difficult. It might be a little misunderstood. But if you need to expand your business, you have no choice. You're going to have to go and get a commercial property one way, shape, or form. So you have no choice. But if you're looking to invest in commercial, it's a great investment. If you have the right team behind you that knows what they're doing, you can close on a commercial property and make a good amount of money. More than you would in the stock market, potentially. More than you would in a bank, just collecting the interest. More than you would in a CD. Because money market accounts, the CDs are probably 4 or 5% max. You could make a lot more than that in commercial real estate. But you have to know your way around the lending or have someone who does that can advise you, direct you, so on and so forth. It's a fact of life, guys. It's something that we're so used to in the United States. Maybe in other countries, they do a lot of cash deals. They don't do lending, or lending is a lot different than it is here in the States. But it's just something that we got to deal with. It's a fact of life. And if you're going to get involved, get yourself a good lender, get yourself a good commercial lender, figure out what type of lending you want, and then find a good lender in that arena, whether that be a debt service lender, whether that be an SBA lender, whether that be a traditional lender, private equity, and learn what you got to go through. And then once you do, getting a loan like that is great. And then once you have a successful go around with it, you'll be doing it over and over and over again. It is a necessary evil. I know a lot of people that have had bad experiences and will never do it again, shied away from commercial real estate, commercial investing, and it will never do it again. I feel really sorry for those people because it's a great opportunity. It's a great investment tool if you have the right team behind you. So I encourage it. Highly invite everyone to ask me any questions that you would. I would connect you with a lot of different lenders in the states that I broker real estate in: Texas, New Jersey, soon to be New York, and also Florida. So, if you have the questions, if you want to talk to lenders, I've got multiple you could talk to, but I highly recommend it. I highly recommend you understand what you're going to get involved in. I highly recommend you understand the types of interest rates, the types of paybacks, like in a business application, you write a mortgage on your property. Let's just say the building is $1 million and you do really great 1 year. You signed a 30-year mortgage, a 20-year mortgage, and in year 2, you did so well that you made enough money to buy the building 10 times over. You want to accelerate the payments because you don't want to pay payments anymore. You don't want to pay the interest. You want to pay it all off. If you signed a mortgage with a prepayment penalty, if you pay the note off within a certain time period, you're going to have to pay a penalty. What that penalty is, it's all in the documents that you signed. But this is all stuff that you wouldn't necessarily know. You would have to have someone explain all of this to you. Commercial loans are great. They're great for a lot of reasons. They help people buy properties, buy other businesses, buy things that they need, equipment, vehicles, whatever, without using a lot of your own money. Do you have $1 billion where you can pay $3 million for a building and not feel it? I don't know. God bless. You don't need any loans. But if you are on tight margins and you are trying to expand your business or start your business, you're going to need loans of some kind. You're going to need a mortgage. You're going to need a line of credit. You're going to need a lot of different things. And it's great. It's great to have. It's great to have access to those tools because they are tools. But you have to know what you're doing. You have to know, or at least be educated by someone who does know what they're doing. So, I feel that this is a great subject. I feel like this is a subject a lot of people don't know about. I feel like this is a subject that a lot of people get burnt in the world of business, and it causes them to never want to talk about loans or, buying anything big like ever again. And I think that's wrong. I think it's a disservice to anyone, any professional to your clients. It's a disservice to your clients if you are a professional and you are not properly explaining and advising to your clients what they are looking to do, what barrel they're looking down. But if you need access to the cash, if you need the loans, I highly recommend you surround yourself with a good team that knows what they're doing, that can help you and advise you and lead you to success. Because as fiduciaries, as professionals, licensed professionals, that's what we want. We want our clients to be successful, because when our clients are successful, we are successful. And when our clients are successful and we're successful, it's a great marriage. It's a great relationship. And when we're both successful, they will continue to come back to you and they will refer other people to you because of that level of success. Those are my only thoughts. Those are my opinions, the way I think, my viewpoint. Can't speak for everyone else. But that is all I have for episode 15, guys. With The Banker Day Trader by H. Upman and my now completely gone Apple Winter Old Fashioned, we spoke this evening about commercial lending and the different types. And I didn't cover all of them. I was just speaking in generalities. There's a lot of other really sophisticated types of loans, but I hope you enjoyed this. This is all I have for tonight. Hope this gave you some sort of insight. And I pray that you stay blessed. And above all else, keep it rolling, baby. For Sticks and Stones, I'm out.